Long-dated bonds have fallen out of favour. Is this the taste of the future? Long-dated bonds are facing renewed selling pressure, creating a headache for investors around the world. As well as the lingering debt strains, politics has been a major factor. In the UK, the pressure is mounting ahead of the upcoming budget. Meanwhile, France has just been thrust into yet another political crisis. Investors want the bond market to be safe and boring. Is that no longer the case? Anna MacDonald is investment manager at Aubrey Capital Management. So Anna, are we now entering a prolonged period of higher borrowing costs? And what would that mean for markets?
I don't think we are necessarily. The US looks pretty likely to cut rates. That's almost a nailed-on cut, it seems, the way the market is pricing it. And that's on the 17th of September. And that does tend to sort of put pressure, perhaps downward pressure on yields elsewhere. However, what we have seen is, as you've pointed out, there's the UK and there's France, where there do seem to be some quite particular issues. UK inflation remains stubbornly high, and it's useful to remember that about a quarter of our debt is index linked. So that's actually pretty expensive for us to service, as well as having to actually borrow at more significant interest rates. So I think the debt management office is trying to issue a little bit less long-term debt. There was a pretty successful 10-year auction earlier this week, so that's quite helpful. But I think that we might see UK and French rates continue to diverge from the US.
Let's look closer at the UK. Is there any way Finance Minister Rachel Reeves can win over investors in her upcoming budget?
Well, I mean, it's a very thorny issue, this. I think she needs to be honest about the problem. We saw that the budget that was delivered in October last year really wasn't helpful for growth. Those national insurance contribution rises that employers had to pay, lowering the threshold, and the increase in the national living wage and things like that are really not helpful to build a flexible workforce, to encourage hiring and to build business confidence. So I think that she needs to maybe be aware of that. There's quite a lot of personnel change at number 10 this week. We saw some economic heavyweights join the number 10, so to work closely with Keir Starmer. So perhaps better communication will also help. But, you know, there are also other ways that she might sort of think about the fiscal rules. She could maybe exclude defence spending from some of those fiscal rules, which could help, and that could perhaps make things a little bit easier.
Meanwhile, Bank of England's Bailey played down the importance of the surge in gilt yields this week. What would prompt action, and what's in the Bank of England's toolbox?
They would need to be very careful about the mandate they have, which is guiding inflation towards target. And ironically enough, those national insurance contribution rises have actually contributed to service sector inflation. So I think that, and actually there's another point, the Bank of England, it has a single mandate, that's to target 2% inflation. The Federal Reserve might respond to weaker job data later today because they have a dual mandate of employment and inflation. So I think the Bank of England, a weakening economy will put downward pressure on inflation, they hope, but it is proving pretty sticky. We're not in a crisis. We just have to pay more for our debt at the moment. So the markets are functioning normally.
Over to France now, and lawmakers are preparing to topple the government at a confidence vote on Monday. What would this mean for French bonds?
I think the bond markets have already priced in the defeat, but it's about what happens next, how Macron deals with it. We don't know what the far right's economics plans aren't clear. They like to be quite populist, I would have thought. So there's going to be a lot of uncertainty, but French bonds are already trading a good, well over 1% more expensive than German bonds, which shows that is being priced in, but who knows what happens with the levels of uncertainty we might see.
But if we zoom out, will the effects spread across Europe, as in further rating downgrades surely trigger a substantial euro reaction?
The French finance minister did actually say it's possible to go to the IMF, but then he kind of walked back that statement quite quickly. And remember that the ECB can step in if there is an issue, but it shows again, I suppose, the difficulty of trying to balance one single country's economy within a much broader Eurozone, because there isn't the option to have a weaker French euro and maintain strength elsewhere. So I think it's quite a tricky thing, and I think keeping political stability and France's esteemed place in the Eurozone will be key, and that's where they're going to have to solve this at a domestic level.
That was Anna MacDonald at Aubrey Capital Management. Don't forget, you can watch more videos on Reuters.com.